Hello, welcome to part 2 of profit and loss statement. So in part 1 you learned about the format of a profit and loss statement, and in this part we will see example or see example of a real company and compare it with one of its competitor, and we will also practically see that as a retail investor, as a new learner, where you have to go and check for profit and loss statement. Obviously companies also provide that on their website. You can go and download from there, but then for every individual company it might not be very convenient for you to go and download and then check from there. So what we will use that, obviously I have no collaboration with any of these two sites, but more often I use them as well. I have been showing you people also about those websites. So one is the screener and another is money control. Now the way they both present certain data, sometimes you might get confused between those two also. So I have made sure that I explain you that where exactly you can get confused as well. So what we will do that we will open both of the website and then compare one company data on both of the website, and then probably freeze one platform and then compare it with its competitor. So that's how this profit and loss statement class will proceed. So let me first open screener. Now let's say the company which I want to select here is Tata Steel. Right, so you can see Tata Steel as a company which is currently traded at 253 rupees and showing a market capitalization of 28,500 crore. So on a screener, you just have to scroll down and you can directly click on profit and loss statement, and you can come here as well, or you can simply scroll down and see. So here is the profit and loss statement. Now you have learned that there will be sales, there will be profit, and then there will be profit after tax, and EBITDA is one word which I explained you. So let's try to see that what all has been adjusted here. So here they are showing you sales. Now in sales they are showing you sales growth also. Screener is showing it in this way. Now this total sales here on a screener is different from what you will see in the money control. When we will see the money control, we will talk about their format. We will stick to this format. So they will show you sales, then they will show you all the expenses which I explained you, like OPEX 1, OPEX 2, OPEX 3. So they have all clubbed it together. What I told you, EBITDA, is something what they are showing here as operating profit. So they made a sale and they incurred a cost. Whatever is left out is operating profit what they are showing, right? Then they are adding other incomes here after operating profit. So this is why I wanted to tell you that there will be some confusion when you exactly want to compare screener with money control. However, money control and the published report of P&L from companies will be more closer. Numbers will be same. The only I'm talking about is the representation. So you do not have to get confused in the representation. Even though the representation of money control is quite aligned with the balance profit and loss statement of the company official report, I prefer screener, and that's why I'm also explaining you a screener, because it gives you in a very clear, neat format, and it's very easy to quickly compare between 2 3 companies, so here I'll explain you these terms because this is important. So expenses you understand, OPEX. Then OPM percentage is what they are calculating as like the total profit percentage, operating profit percentage, divided by the total sales. So that's how they are calculating the percentage. What I mean to say that 1,48,000 sales and 19,000 operating profit will be 13%. 13% of 1,48,000 will be 19,000 crore only. Now, what is this other income? So companies have core business. So Tata Steel core business is to sell steel, manufacture and sell steel. It may have retained profit which they will put into FD. They will earn certain interest from them. They may have warehouses which they may put on rent, or any other facility which they might be putting on rent and earning money from there. So that cannot be put in the total sales and the operating profit. They will put it in a different category called other income, which may fluctuate here and there. And that's why it is important that you understand it, and that the other income is not something we have to consider many of the time when you are doing the fundamental study of one company. But you cannot ignore it also, because at the end of the day the total net profit will represent the other income as well. So in some cases, in certain industries, these other incomes could be very, very high. Now here you have interest and depreciation. So the interest what they had to pay and the depreciation on the asset which has happened, they will subtract these two. However, they are going to add the other income into the operating profit. So when you will calculate, you have to add these two and then subtract these two, and then you will get profit before tax. Let me show you by example as well. So let's say open the calculator. Now operating profit of 19,210 crore plus 1,110, that comes down to 20,320 crore. Now 8,097 crore, this minus 8097 comes down to 122223 minus 7546 minus 7546 4677. So you do not have to get confused that all these three will be subtracted from this. No, this is other income, and that's why I shown you the calculation here only, when I'm recording this class for you, right? So this is your profit before tax, which you learned in the format as well in the previous class. And then you have net profit, right? So net profit will be after tax, whatever the profit is there, that net profit will be adjusted here. Then you have something called EPS. EPS is earning per share. So 45 rupees of earning a company has made on its one share, and obviously they declare it on every quarterly results. If you see on every annual report, and that's how at the time of the annual report, whatever will be the share price and what will be the total earning, they will divide by that, by number of shares, and that's how they will come with earning per share. At this point of time, I'm not going to talk about this ratio much, because here it will not make any sense. All the ratios I'm covering later. So for now, you can say that one share is earning 45 rupees. One Tata Steel share is earning 45 rupees. This number independently will not make any sense, because some companies may have very high number of shares, and the share price will be low. At that point of time, this EPS may be 10 or 15 also. So you cannot make any conclusion out of the EPS. EPS always have to seen a standalone. However, the ratios are there so that you can compare the ratios between 2-3 companies. It is used for the relative valuation, but EPS will be not used for the relative valuation. It will be more focused on one company, and that's why I'm not explaining you much on the EPS and want to stick on the profit and loss statement. So what you have seen here is total sales. They have shown operating profit after dividing all the expenses, which is correct. They added the other income and then subtracted interest and depreciation. Everything is fine as per our original format of the profit and loss statement. Then you get profit before tax. You have to pay taxes, and then you get reported your net profit. Here it is TTM. TTM is like last 4 quarter. They sum the results of all the last 4 quarter results. So if I go and add this plus this plus this, you will get this number. So don't get confused between TTM. Latest quarterly result, latest annual profit and loss is this much. March 2019 they reported. They are supposed to report, they will now, after this March 2020, now that it's over, we are in April, very soon you will see March 2020 annual profit and loss statement written here. And then again they will give TTM, because once one quarter is over, because they want to show you that how this company on the profit and loss segment have done in a complete year in last 4 quarters. So both of the numbers this screener give you, and actually it gives sometimes help you also. So it is good that you understand that what is this TTM thing. Right. Now the profit and loss statement on screener.in is something which you have understood. Now we will go to money control, and again open here Tata Steel. Then you have to go to financials. Within financials you will see profit and loss. It will open another screen. We will close this. Now in this profit and loss statement, they have old format and new format, so I won't confuse you between old format and new format. Why not, let's adapt the new format only and stick to this, because anyway we are covering two different, one is a screener, another is money control. So here if you see the format is little different. Like if you see, they have included the other income here itself in the total income. They have very categorically written operating profit here, means from steel sales they have given you the total sales, which is 70,000 crore. Other income is 2400 crore, and this is March 19. Now we will see March 19 numbers here, and the sales is 1,57,000 crore. I was talking about this confusion as well. If you see, the total revenue of Tata Steel is coming at 73,000 crore. If I add the other income, even if I just add total operating revenue, it is coming at 70,610, right? Now you will say that 70,610 is on money control, but when we see here on screen it is showing 1,57,000 crore. So what you need to do is, you need to read here that here it is showing consolidated figure, here it is showing standalone figure. So you have to aware about this. So this is showing standalone. I'll turn this to consolidated, and then we will see. And if I placed consolidated, and now I'll go and check the total operating revenue, it is 1,57,668 crore, 1,57,669 crore, which is exactly the same. It's just that they have rounded off 0.78 to 69. So consolidated and standalone is something which you have to understand. Standalone is that Tata Steel independent operation. They reported their standalone profit and loss statement. I have purposefully picked up Tata Steel to show you something, to explain you something. So Tata Steel acquired a steel plant in London, which is Tata Steel Course. If you go and read about this company, you will come to know. You go and you can know, you must read about this case study. This is a very many articles you will find that Tata Steel acquisition of Course. It was one of the very pride moment for India that one Indian company acquired a company which was at least 2 times bigger than the main company. So Tata Steel and Course deal, where Tata Steel not merged, but they acquired Tata Steel Course, and it became Tata Steel Course. You can call it merger acquisition. And then Tata Steel became one company, and their sales, obviously when you see the consolidated sales, it is the complete group sales, and that's why you see that the group sale is 1,57,668 crore. And here in the consolidated also, if I go and check only standalone and click here standalone as well, you will see that in standalone they have total revenue of 70,610 crore. Here it will be 70,611 crore, again the rounding off which has done. So never ever get confused between consolidated and standalone. Ideally, you should always look the consolidated profit and loss statement of a company, because once a company has invested or acquired another company, they will always abide by them. They will always help that company. The other company which is they have acquired will be always bringing positive and negative forces both to the company. So there is no point. There will be point in terms of knowing the efficiency of the parent company or the main company. But when you see that this parent company standalone consolidated numbers are much bigger than the standalone number, then at that point of time it is very important that you stick to the consolidated figure and not to the standalone numbers, right? However, in some cases you will see that the consolidated and standalone will have very minimal difference in them, right? So at that point of time you can stick to standalone. But in a case like Tata Steel, because it is not easy for Tata Steel to just drop Course and become again an independent Tata Steel company, it will be not that easy, right? Not that an easy decision. So in this case we will understand the consolidated numbers and try to compare. Now coming to the format of money control. So the format of money control is they club all the incomes together and show you the total revenue here. They subtract cost, all the operating cost. So cost of material consumed, you understand that. So for steel you will need a lot of other materials as a raw material. Operating and direct expenses in processing that material. Employee benefit cost, so employees needs to be hired, and then their benefits will be there, like their retirement benefits and all everything else. So even if they are paying it right now or not paying it, they'll keep on calculating on the profit and loss statement and also incur it on the balance sheet. Financing costs, so they have taken debt, they are paying interest, so that financing cost is there. Depreciation, you understand, I have explained in the last. Amortization also you understand. I would like to again tell you about depreciation and amortization. So depreciation is when you have asset, that asset will keep on depreciating. Machineries will get old and they will not draw the same value what they had when they were originally purchased. They are the tangible assets, something which you can touch, which you will use. There are intangible assets which are also giving you a cost, and their value is also decreasing. Let's say you have done any patent, or that patent is only valid for 20 years. Now if you have included that, so those intangible assets will get on depreciating also. Your clubbed loan where you are paying interest and the principal also will come into amortization. So you have to subtract that, you have to consider that as an expense as well. Other expenses is listed down here. This is something very important to understand, that in a company like this they have given a very big number which is other expenses. So obviously when you are going into detail you have to understand about the other expenses as well. Then total expenses they have given. Profit and loss statement, they have shown you that all the profit before tax is, so EBIT, what you can say, profit before, no, so EBIT will be, since interest cost and financing cost they have already included, this is something called profit before tax. So profit before tax is 15,801 crore, and this is your profit before tax. Then obviously the tax and the other liabilities, total tax expenses they have calculated, and consolidated net profit they have given you here is 10,218 crore. So if I go and compare few things which we can see here is the consolidated number we have to see in a company like this, However, before going and checking, we have to check both of the numbers, whether consolidated, how much is the difference between consolidated and a standalone, and with your own judgment that how one business is affecting another business, how major or minor the difference between a standalone and consolidated numbers are there. You will use your judgment and then accordingly check. The safest side would be always to go and check the consolidated one. That is my statement, right? So net profit is something which you will always go and check in the very beginning whether the company is posting a net profit or not, right? Then once you go and see the net profit, obviously I have shown you a way to value the company, a way to compare it with the FD returns, right? So the very basic thing which you can see that a company which is a big company which is having a market capitalization or a certain book value of that company, on that capital employed, on that total capital which is employed with this company, what kind of rate at which they are posting profit is what you can get here, right? For example, now I'll stick to money screener.in. So what you can see that, you know, the book value of the company is 644 rupees. This is 253 rupees, the current market price. Okay, at current market price, this is posting that market capitalization of Tata Steel is 28,500 crore. If I calculate this ratio, I would assume that this will become approximately 70,000 crore, right? So can we do one calculation? So if I go and 6 for calculator, 644 divided by 253, 2.54 into 28,588 crore, 28,588 crore, which is like 72,000 crore. So what you can see that at book value, this company worth 72,000 crore, and they are posting you a profit of 10,000 crore. It is a good profit or bad profit is something which you can judge when you compare it with normal FD. Is it a very pure and the right method to compare? No, not at all. But it will give you a glimpse of how this company is doing against its total net worth or its total worth as per the book value the same company is giving it to you. Obviously, this book value in the next quarter will change depending on how Tata Steel have done in the last quarter or last year, right? And that point of time, you may find it this is not a 72,000 crore company or maybe lower. And at the same time, this profit which you are seeing here as 10,000 crore profit may get posted lower also. So you have to be quite aligned with the very latest performance of that company, right? So last 4 quarter, if I see, then I see that they have posted one loss in December. March is December, January to March is expected. Before that, they were decently doing well, quite aligned with the profit and loss which they have posted in March 2019, right? So you can get one glimpse here, but then if you really want to make the best use of profit and loss statement analysis, and we have picked up this as the very first financial statement analysis, then the best thing which you can probably do is you compare it with its peer. So initially, on the very first stage, what you can do that you can simply see whether in last 10 quarters they have posting profit or not, their profit is growing or not, because a company sales and a profit both should grow, then only one company will grow, then this company will create value for its investor. We have been learning about power of compounding, and this power of compounding at the end of the day compounded sales growth and compounded profit growth is something which you have to see, and obviously the net profit will play a major role there. So as a very novice investor, or the very first time, if you are looking at the profit and loss statement, my suggestion would be very basic, in a very common manner. Just look at whether they are posting profit or not, and their profit is increasing or not, their profit is aligned with the sales or not. So sales is something also you can see only into the profit and loss statement, right? So the very first layer, what you can do, that standalone, if you are looking at one company, standalone, when I'm meant to say that, not comparing it with its peers or its competitor, just looking at one company, you must see that the company sales is growing or not, and company net profit is growing or not. Even if you look at least this much, you'll be able to find the value investing for yourself. You will be able to understand whether one company is a value buying or not. If they are not, if their sales is not growing, their profit is not growing, mind it, again and again, what I'm saying is it should grow. So if previous quarter it posted 400 crore of profit, this quarter they should at least post 420 crore of profit, kind of. Consistently 400 crore of profit is not going to make this company grow on an exponential way or in a compounded way. Every year if you are growing at 400 crore net profit, it means you are growing linearly and not exponentially. So this is what you have to must see. Well, in case of Tata Steel, you can see that it's neither linear, not exponential, and that is one of the reason. If I see the stock performance, you can see that how exactly it has fared. It's fine that market has crashed from certain levels, but then if I go and see from last 5 years, or even if I see the graph of, this graph is not like, if I compare it with another company like Bajaj Finance, and if we see, yes, they were overvalued and crashed big time in this market fall, but before, if you see, it was very much aligned with the total sales and total profit compounded growth, right? Here in Tata Steel, you don't see in their graph, you don't see in their profit and loss statement as well. So if someone tell you that looking at numbers don't make sense, it's a pure lie. Looking at numbers makes sense. It makes sense, and if you pick up hundreds of companies, and you should pick up hundred of companies and see whether their sales is growing or not. If you plot the graph of their sales and profit, you will see that in 95%, 99% of the cases, that graph and the stock performance graph will look similar. In few companies, for longer period, the overall sales and profitability will not probably reflect into the share price, but in most of the cases, if compounded growth in sales and profit both are there, these companies will keep on giving a good return to its investor. Share prices will increase, right? So my idea to discuss, or something which I want to give you as an instruction, is the very first thing what you can do is do a standalone independent analysis of one company on their profit and loss statement and see whether their sales is growing or not and their profit is growing or not in a compounded fashion. This is one. Now, where you can use profit and loss analysis more in terms of understanding it, picking in terms of identifying one stock, whether it should be in your portfolio or not, is what you can do the comparison with another company. So obviously the comparison part, first you have to understand it theoretically, and do it theoretically by doing the research on the competition of one company with its peers. I know it that right now the biggest competitor, or the one competitor where I can compare Tata Steel and Tata Steel with someone, is JSW Steel. So what we will do, that we will now try to see that how exactly Tata Steel is doing in comparison with JSW Steel. So what we will do is we will open in both window. Right. So, and here you have JSW Steel. Right. If you look at JSW Steel, their consolidated and standalone number don't look, that the difference between the consolidated and a standalone is not that big. If you see, this is 76,000 crore, otherwise it is 84,000 crore. In case of Tata Steel, what you can see that it is 1,57,000 crore, but if I see a standalone, I can see it here 70,000 crore. Now what we will do that we will compare in both of the fashion. So the very first time what we will see is we will compare standalone with the standalone. And if I see standalone to standalone, what we can see here is Tata Steel is making a sales of 70,000 crore. Tata Steel India, JSW Steel is making a sales of 76,000 crore. If I go and see their sales growth and the sales growth of Tata Steel, we can see that both of them are going quite similarly. Then between March 2018, we can certainly see that JSW Steel has given in 17 and 18 better results, better growth, sales growth, and that's why their India sales you can see is little better. Now expenses, if you see, material cost for Tata JSW Steel is 56%. For Tata Steel is 30%. Now, if I see that they are producing the same stuff, steel, what would be required for the material? Iron ore. Now, JSW Steel is having 56% costing on material. However, Tata Steel is having an edge and just costing 30%, 30.31. So we must find out why it is happening. Reason could be Tata Steel will be owning iron ore, iron mines, few of the iron mines, and they are using that. So these are the differentiation which you have to find between two companies and compare that. So once you have decided that out of your 10 lakh rupees or 50,000 rupees, you decided that steel is one sector which will be intact or which will have its demand even in future, because India is a growing economy. India is a growing country. For infrastructure, we would need a lot of steel. At that point of time, you will go and see that, okay, fine, I want to invest 10% or 15% of my total portfolio into steel sector. I have two companies, Tata Steel and JSW Steel. I want to invest into one. And then other small companies are also there. I may want to compare with them as well. So at that point of time, when you are selecting one of the good apple, this kind of relative comparison is something which you can do using profit and loss statement. I don't want to get into very detailed lecture on what all heads you can compare, but certainly everything what is showing on a screener, these things you can go and identify and get into more detail if you really want to be a value investor and want to be one guy who want to pick up companies with their own conviction and looking at the strength of the companies, right? So if I see standalone, we can see that Tata Steel is having an edge over JSW Steel. Now, I don't want to recommend that you buy Tata Steel here, but what I want actually is you go and identify more numbers and compare more heads between them and try to understand that which company is having better edge than other company. or which company is having an edge over the other company, and try to select the one which is most favorable to you. Now, I'll go and look at the consolidated one. So if I see the standalone, we can certainly see that Tata Steel is having an edge, and not there, but you can see, you can also, something which I forgot to show you. So OPM percentage is 29 for Tata Steel, and for JSW Steel it is 24. So operationally, Tata Steel have been able to post better operating profit out of their sales than JSW Steel. Now, if I go and see the consolidated one, however, if you see the share price growth, you will see that JSW share price has done better. If I see long term, see, than Tata Steel. Now this is something very interesting to see. It is interesting to see because if you see the compounded annual growth rate, you will see that the sales growth and profit growth, except that the latest quarter, last four, the TTM, they have shown a consistent sales growth and compounded growth, profit growth. So Tata Steel was already a very, very big company, and JSW Steel became big company in last 10 years, 15 years, and they have consistently shown compounded sales growth and profit growth both. So the graph when you see of Tata Steel, and when you compare it with JSW Steel have been consistently showing good numbers on a compounded rate, which Tata Steel is not showing, and that's why people have made money in JSW Steel. People have invested 20 rupees in JSW Steel, and the share even after this market crash is 150 rupees, right? So numbers work. My job is to make you convinced that stock market is not a complete gambling unit, but if you really understand how to analyze and you spend time analyzing, you will be able to find out that the very basic fundamentals of compounded sales growth and compounded profit growth work, and at least you need to know this much even before knowing the balance sheet. That was one of the reason I included profit and loss statement as the very first financial statement into fundamental analysis class. Right now, I quickly want to close this class by covering since Tata Steel was efficient and is still not showing compounded sales growth like JSW Steel, there must be a reason behind it. So the reason I'll show you in their consolidated statement. Now I compare their consolidated one. Now in consolidated, if you see, the OPM percentage has dropped down to 18% from 29%. Why this has happened? Let me show you. In Tata Steel, if you see, the material cost in consolidated is still 37%, but their total employee cost, and if you see the employee cost here, they are just spending 2.5% on employee salaries. Here, they are spending 11.92% on employee cost, right? So due to their Course plant, which they have acquired around 14 years back, people in London is not that easily available at lower salary. You know the London salary, right? You all know. They have been paid in pound and their salaries are better than India's salary. This is one thing which is pulling Tata Steel down. And that is why you see that their operating profit, it has gradually gone down in last 10 years, 15 years. However, the operating profit of JSW Steel has gone up, and you can very clearly see that where exactly this cost is coming from. Now, if only the employee cost difference is around 9.5%, it will bring down the profitability like anything, because these companies work on a very small margin of profit, right? So now, even if there was a confusion that even if Tata Steel is having better OPM in India, why its share prices have not grown as JSW Steel, this is one of the reasons. So numbers will speak in the favor of the share price. You need to go and learn in detail. If you are finding confusion, try to clear out those confusions. Number will not lie. P&L number will not lie unless and until it is fabricated. In smaller companies, even these numbers get fabricated. You have to be aware about that. You have to identify more. Initial days, unless and until you know one company which is very, very well, you cannot only rely on the P&L statements. You also have to go and do the qualitative analysis as well. I'm not saying that India is a country where most of the companies P&L numbers have been fabricated, but we have seen enough example, and that's why I made an made a statement. I didn't mean to defame anyone that people book, people are crook and they fabricate their P&L number or balance sheet number. No, those cases have come. So you have to be careful. This is what I wanted to say. But then you have to start your analysis with P&L statement. Look at the compounded sales growth. Look at different level companies efficiency. Look at on those levels whether those inefficiency or efficiencies are going to be there for the short term, and you can still bet on them and try to pick up your stock, right? This class can go as long, if I take 20 examples, it will become 20 different classes, but the idea is to cover this course also and finish this course as well. So my job here is to show you the path and show you that, on which path you have to go and start digging numbers. So this is the path you have to take when you are going to do any value investing, when you are going to do standalone analysis and relative analysis as well between one company and its peers and competitors. Well, on this note, I'll close this profit and loss statement class, and obviously we will take more examples in doubt clearing session, when we will have doubt clearing session on fundamental analysis with you, right? And if any, obviously when I pick up these companies or numbers in the example, idea is to just teach you and show you certain things which I'm aware. This doesn't mean that I may not be doing one or two silly mistakes. If I have done any silly mistakes, you must point it out, and thank you. You point out, I'll try to correct. However, whatever I have covered and told you about Tata Steel and JSW Steel and showed you the comparison was purely for an educational purpose, not a recommendation to either buy Tata Steel or JSW Steel or invest into steel sector. You have to first do the sectorial analysis as well and try to see whether sector is aligned with the economy performance or not. On this note, I would like to close this chapter and let's jump to the balance sheet, which is the next chapter. Thank you.